All right, welcome back to the channel. I'm not gonna lie, I missed you. I missed you last week. I missed not making the content, but I was in London for 3 days doing some client work, and sometimes client work does take precedent. But I will say this: it was nice to be back in London. It was nice to be back home. 21-degree heat, landing at Heathrow with cool breeze was. I've missed that. I'm not gonna lie. The breeze here is pretty much humidity all of the time, so it was very very refreshing. Getting around London, a little stressful. Tube strike and all that. I've got to come back in October because one of my speaking events last week was actually cancelled, so I've got to come back for one day in October. But I cannot complain. Now, last week, obviously, I was away, so I didn't get to make content. All right, but I was on Instagram with reels and information. So if you're not following over on Instagram, you should definitely go and follow. I will leave a link in the description there as well. And we're going to start today's show looking at something that I picked up last Wednesday in the mortgage realm. But before we get started with that, obviously I make financial content here. I try and make it as interesting and as informative as possible. We do scribe, so you've got a visual way of actually taking the information in. It's going to be the same today. We'll cover an article, we'll do a scribe, we'll talk about what this article is talking about and pick apart what you need to know so that you can make the best financial decisions. So if you do get value from this video, consider subscribing, hit the notification bell, and you'll get notified when I upload videos like this. But let's jump into the headline and the article, which is from the Telegraph last week. And it says this: mortgage lenders ban deposits from Bank of Mum and Dad. Now, quite a strong headline, I would say. It's definitely a tabloid headline, right? Mortgage lenders ban deposits. Like, okay, interesting. Tell me more. And it says here that the new loan is reserved for first time buyers without access to parental help. So it's not that they're banning deposits from the Bank of Mum and Dad. They're just saying if you don't have parents that can help you with the deposit, like I didn't, then we have a mortgage product specifically for you. Now, I did make a reel about this on Wednesday last week, okay? And these are the stats. Really, really good stats actually. So at the moment, it's got just under 142,000 views. It has 304 comments. It has 1,557 likes and 1,043 shared. So something that I have noticed is in the comment section, lots of debate. Lots and lots of debate. And what I can't show you in this stack at the moment is the poll that I posted alongside the reel. And the poll basically just asked people, is this something that you would use? And after 1,125 responses, 64% of people said no, we would not use this kind of mortgage. Now, I'm not going to lie, low key, that fills me with joy because I think there is a healthy level of skepticism and critical thinking around these types of products. So what we're going to do is we're going to dig into what this product effectively is. We're going to talk about who this is for, who it's not for, and then we're going to talk about one major concern that I have, which I believe people have already clocked and will have clocked by just following what we're talking about so far. So let's just go back over to the article really, really quickly and just get the lowdown on this. So this is something that's been launched by the Newcastle Building Society, okay? So they announced that it would loan up to £350,000 for first-time buyers with deposits as low as £5,000. However, the lender stipulates the buyers must fully fund their own deposit. So the deposit has to be fully funded by the buyers of the property, the people who are going to be named on the mortgage. No Bank of Mum and Dad. Now, the numbers here, for me, I read it and I was like, property up to £350,000 with a £5,000 deposit. That's a 1.4% mortgage deposit. And when you consider that the norm is 10%, you could get away with 5%, the amount you're having to put into this thing is substantially lower. I mean, at 10%, you're looking at £35,000 deposit. At 5%, it's £17,500 deposit. You only need £5,000 deposit to take advantage of this mortgage. Let's read on. It said the 5-year mortgage, which has a fixed rate of 5.25% over a loan term of 35 years, was designed to ensure home buyers without parental help would be able to get on the property ladder as house prices rise further out of reach. Now, I do think that there is positive intent in this, and I think the intentions are pure. And I personally think, and this may not be something that will go down well with people necessarily, is that I think we're entering into an era where the banks are willing to go beyond and take a little bit more risk in order to support their customers. Now, I know that's ironic to say when you look at 2007, 2008 subprime mortgages, self-certified mortgages, so on and so forth. There is a huge argument to say that are we heading in exactly the same direction? I 100% hear it. But I do think the capital adequacies that were introduced after 2007, 2008 will play a part in allowing the banks to do this and not being too over leveraged. So there's a couple of things I really want to get through here. So this is a 5.25% 5-year fixed rate mortgage. I think that's really important to note because where are we right now with the bank rate? I think 4% or something like that, right? 5.25% is pretty high. On a 5-year fix, that's pretty high in terms of the term that you're getting. My initial reaction, having written mortgages in the past, is that number one, there are the merits and demerits. The merit here is, as a person who might be using this to purchase your first home, on a fixed rate for 5 years, you know exactly what your mortgage cost is going to be. So it's going to help you plan financially. You're not going to have any nasty surprises on a monthly basis, right? My mortgage is this, 5 years, it's fixed. On the other side, I'm thinking from the bank, the lender's point of view, 5.25 helps mitigate, or at least will reward them for the additional risk that they're taking in this mortgage deal, for sure. The demerit that you have here is that, unfortunately, because the mortgage deposit is so low, and this is where we are going to go to ascribe right now, you have a substantial risk. And when I say substantial, I mean a substantial risk of negative equity. And that is a place that nobody wants to be in. All right. So typically how it works is, let's just say this is your house, right? You bought this for £350,000. And let's say this piece of the home here is a 10% deposit. So £35,000. Okay. This effectively gives you a financial cushion. So that if you look at the market value of the home, and let's say this is the market value of the home, right? Equal to your mortgage amount. If the market value of the home tumbles, right, it means that effectively the cushion that you have here gives you, I guess, a buffer to how much the market value can fall before you fall into negative equity. So negative equity will look like, in this example where you've bought it for £350,000, you put a 5k deposit down, which means that your mortgage is for £345,000. If the market falls, and let's just say the value then falls to £300,000, well, now you owe £345,000 on this mortgage, but the market value of the home is only £300,000, which means you're £45,000 in the hole, in the negative. This is a real risk for anyone looking to use this mortgage. And this cannot be understated in any way, shape, or form. And the reason why this is important is because, just remember for a moment, what they're offering you here is a 5-year fixed mortgage at 5.25%. So whilst your mortgage payments are going to be fixed for that period of time, if you got to the end of your 5 years here, and let's just say your property value is £300,000, you may have issues remortgaging, because they will, when they remortgage, they always look at the property value. Has it gone up in value? Has it reduced in value? And if in this equation your property is now worth £300,000 by year 5, and because of amortization and so on and so forth, you've only paid off, let's just be I don't know, you've only paid off £8,000. So you might still owe £338,000 on this. You're still £38,000 in a hole, which means that you may not be able to remortgage onto another fixed rate. You may have to then go onto a standard variable rate, and standard variable rates right now are 7-8% per year, which means that your low mortgage rate at the very, very beginning, because you fixed it for 5 years, now takes a dramatic jump. And because of the negative equity in the property, it's going to be even more difficult for you to move from Newcastle Building Society to say a Halifax or a Barclays or somewhere like that because of the negative equity. So this is a really big risk. And this leads us back to, well, who does this type of mortgage suit? Now, if you're someone like me, where there was no help from my parents to help me get on the property ladder, this will definitely help you. But you have to understand and acknowledge the risk that I've just explained prior. Now, if you're the kind of person where you have mum and dad that can help you with the deposit, then you're not going to use this. There might be another product with Newcastle Building Society or another provider that you would use. You wouldn't use this specifically. And this is something that I saw on Instagram. People were outraged that how dare they ban money or stop you from being able to use mum and dad's money for deposit. They're not. They're just saying for this particular product, you can't use mum and dad's money. And if you do have mum and dad to help you, that definitely isn't the right product for you. Because if your mum can give you 20 grand, 15 grand, 10 grand, whatever it might be towards, a property worth £350,000, you're going to get a better rate than 5.25%. So this simply isn't the right product for you. What I would like to know, though, and we won't know this until someone goes through an application form and these things then become, popular in the market, what the mortgage term are going to be for this. I'll be very, very surprised if there is not a stipulation around you must have income protection insurance, for example, or some kind of policy in place to help make sure that you can keep up with the mortgage payments if things outside of your control happen to you, illness, sickness, I don't know, accident, whatever it might be. I'd be surprised if there isn't something like that added into the mortgage clause itself. I will also say this, people are already thinking about workarounds. So the workarounds, how do they know it's the money coming from mum and dad? Well, they will do anti-money laundering checks. They all do that. They'll want to know where the money's come from and how it's been accumulated over time. There is an argument to say that, maybe an uncle and aunt could gift it to you, but that doesn't necessarily demonstrate a savings habit. And this leads me on to the next thing that I was going to say, which is people are saying, well, why would they even do this? What's the whole point? And it is to demonstrate that you can have or have got a savings habit, that you're financially responsible enough to save a £5,000 deposit. Now, clearly, to have a savings habit and to demonstrate that, they will likely want to see how you've saved for this over a period of time. So if you've been using things like your lifetime ISAs, I want to see the deposit that you've made over the past 2 or 3 years to get to your 5K deposit. Which, by the way, your lifetime ISA is perfect for this because as an individual, you've got £4,000 allowance, you get £1,000 from the government. Fantastic. So it's a really good vehicle or way to use your lifetime ISA, if you will, in this instance specifically. So I think when I think about this critically, I would say, well, technically speaking, if you made the deposit £10,000 instead of £5,000, that demonstrates more of a savings habit because £10,000 is harder to come by than £5,000. But you get the point. They just want to be able to, they want you to demonstrate to them that you've been able to save the money and you have you're financially responsible effectively. That's what it is. There was something else I was going to mention here, aside from negative equity. I've already talked about workarounds, generation rent. Right, let me just make this point here really quickly. We are definitely in an environment where, for a generation of people, the dream of owning your own home is becoming even more far-fetched than ever. This will help generation rent. People who thought that they will never be able to own their own property. But again, you've just got to be aware of all the pros and the cons. So please, please, please sit down with a mortgage advisor and take the advice. Someone said on Instagram that oftentimes these companies will launch products like this because it's a talking point. And oftentimes when you go and sit down with a mortgage advisor, there is an alternative product that will work better for you than this type. Apparently, Accord mortgages also have a very similar 1% deposit mortgage proposition as well. How successful that has been, I don't know. I think it would definitely help some people, but you've got to really have your head screwed on and you've got to be aware of what you're entering into, because if it goes wrong, it can go really, really wrong. And that's not what anybody wants. I think a lot of this is predicated on the fact that the property market in the UK is pretty resilient. And that's purely because we've not built enough homes and we've got massive, massive demand for the supply that we have. And I think to a certain extent, the property market in the UK is almost always guaranteed to go up and not go down, which mitigates some of the concerns around negative equity, although that could still be the case in the short term. I hope you enjoyed this. I will see you tomorrow. Let me know what you think in the comment section down below, whether you think this is a good idea or not, whether you have someone who would actually use this. I'd love to know. Let's have a conversation down there. See you tomorrow. Cheers.